You will have heard that the Fed reduced the federal funds rate by 50 basis points last week. But do you know how the Fed cuts interest rates? The method the Fed uses to control the federal funds rate now is very different from the method it used before it launched quantitative easing in 2008. This video will explain the Fed's new method for controlling interest rates and discuss why the Fed was compelled to adopt a new method in the first place. This presentation will make clear that interest rates today would be much lower than they are if the Fed were not intervening to keep them high. It will also show that as the Fed continues to cut the federal funds rate during the months and quarters ahead, market-determined interest rates, such as government bond yields and mortgage rates, are also likely to continue moving lower, and that the stock market may keep moving higher. Please note the St. Louis Fed is the source of all the data used in the charts in this presentation. When the Fed launched quantitative easing at the end of 2008, it did so by buying government bonds and mortgage-backed securities. This caused its total assets to surge, as shown here. The Fed paid for those assets by creating and depositing bank reserves into the reserve accounts that commercial banks hold at the Fed. So bank reserves shot up, as this chart shows. Notice that before 2008, there were almost no bank reserves. Now there are $3.2 trillion of bank reserves. The federal funds rate is the interest rate at which commercial banks lend bank reserves to one another. Normally, all the other interest rates throughout the economy, such as bond yields, mortgage rates, credit card rates, etc., follow the federal funds rate up and down. Before 2008, the very low amount of bank reserves made it easy for the Fed to control the federal funds rate. If the Fed wanted to cool the economy down to slow the rate of inflation, it could sell to commercial banks a few of the government bonds it had bought in the past. When the commercial banks bought those bonds, the Fed would take payment by debiting the reserve accounts belonging to the banks that had bought the bonds. Taking bank reserves out of those accounts lowered the level of bank reserves in the banking system. As bank reserves became scarcer, the cost of borrowing those reserves, the federal funds rate, would rise. Conversely, when the Fed wished to stimulate the economy, it would buy some government bonds from commercial banks, paying for them by depositing bank reserves into the reserve accounts of the commercial banks from which it had bought the bonds. That would make bank reserves more plentiful throughout the banking system, and that would drive down the cost of borrowing bank reserves. In other words, it would drive down the federal funds rate. As the federal funds rate fell, so would all the other interest rates, and lower rates would stimulate economic growth. However, once the Fed had created trillions of dollars of bank reserves through quantitative easing, it was no longer possible for the Fed to control the federal funds rate by making relatively small changes to the quantity of bank reserves using the method described above. Post-QE, bank reserves were far too plentiful for that. So the Fed had to find a new way to control the federal funds rate, which it did. It now controls the federal funds rate by paying the commercial banks interest on their bank reserves, something that was not legally permitted until 2008. This chart shows the rate of interest the Fed